Hey, thank you so much for joining us today for the Pegasus Edge 20. This is your 20-minute weekly training that we're going to go through everything from sales topics, tips, product news, as well as just need to know information. I'm your host, Justin Moya. A little bit of housekeeping. If you're on our live training on the top left, you're going to see a chat bubble. Go ahead and click on that chat bubble and you can ask any questions and we'll get back to you at the end of the presentation. Also, I want to let you guys know that we are putting all of these trainings up on our YouTube channel. It's brand spanking new. Go over it. It's just YouTube. Search for Pegasus Insurance. You should see our channel there, and you're going to see all of these trainings that go out pretty much the next day after we air them. So keep an eye out for that, and you can kind of just scroll through. I love watching YouTube, probably the most streamed service in our household, and we want it to be on there to make it easier for you to get access to these trainings as well. Today, we're really going to be talking about living benefits. And living benefits have really changed the story of life insurance. Before, we used to talk about death benefit, and maybe we had some paid on riders that we could do to add these living benefits, right? For maybe some critical illness, disability, something. But now, many companies have just kind of wrapped them in, and they've wrapped them in for a number of years, probably a decade or more coming into this business. And I really want to let you guys know how do these work, because odds are if you're a new agent, you haven't paid a claim. And the first claim that you're most likely going to pay is going to be a living benefit claim, because we have seen more living benefit claims than we have death claims the last 10 years. And that really tells you something, right? Somebody is diagnosed with cancer. I think they say once every 2 minutes in the world. A heart attack happens once every like 3 minutes. So these conditions are just so prevalent in today's society that the chances of you having a living benefit claim are going to be much greater than you having a death claim, especially in your early years in this industry. Now, the market is still huge when it comes to life insurance. There's 106 million Americans that have no life insurance or that are very underinsured, right? And this is, by the way, including those that have got benefits just through work. We have 50% of Americans reporting that they have no coverage at all. And of all 106 million adults, they're overestimating the cost by up to 3 times what a life insurance policy actually costs them. Right? So if we're going out and we're talking to a client, give them a quote. Odds are they're thinking that the cost is going to be 3 times more, and maybe that's why they keep putting it off to, maybe tomorrow, where we can actually get them insured for the lowest cost rate that they could possibly get now, because they're the youngest that they're ever going to be right now. And I'm going to tell you, millennials and Gen Xers are more inclined to have their own personal policy than just relying on their coverage through work alone. So, really, bringing up having an independent policy that they can take with them, that's theirs, they own, it's in their care, custody, and control, is, I think, one of the biggest factors. As long as we can show it's affordable, you have a better shot than not talking to them at all. Now, when I think about living benefits, I'm going to tell you, I kind of almost think about the casino of life, right? If I walk into a casino and I see one slot machine A, and it says, hey, it's $1 a spin, and you have a 2% chance of winning a payout. But right next to it, I have slot machine B, and it's, hey, it's $1.10 a spin. It's 10% more, but you have a 30% chance of having a payout. I'm going to go with option B, right? I want the biggest chance of success of actually being able to get a payout. And that's pretty much what living benefit does. Is it comes in. The chances of you having a death claim on a term policy is about 2%. That's the average. And it's not because, well, you only have a 2% chance of loss. It's because clients change policies. They switch to permanent policies. They let it lapse. They outlive it. Many, many people have outlived it. I've already outlived my first couple of term policies since I've been in the business. I've had to go out and get new coverage. And I'm going to guarantee you that every single coverage I've gotten since has had the living benefits that have been built in. Listen, it's still life insurance, but it has a very different outcome and impact on your clients. That small 10 cents, 10% can mean a very, very big change in the way that your client can succeed in life. A living benefit just gives your client the ability to overcome, right? Not suffer a financial death just because they're still alive. Now, we've seen this many times, right? We've seen this pay out. We've seen that living benefits work. Here's a check that we have in front of you for $33,687 paid from living benefits to a policyholder that was still alive. And by the way, these are tax-free benefits, right? They're not paying taxes at the end. This is all money in their pocket. Here's a letter that we received. Now, this is showing us, hey, if you accelerate, you have a $300,000 death benefit. If you accelerate 100% of your death benefit, we're going to give you $243,000. And not only that, you're still going to have $30,000 left over. But look what happens to the premium. We go from $55 to $7.90. The client's actually paying less. So we give, again, in this instance, $243,000. Here's another letter. We have a $104,000 death benefit. This is an IUL policy. They've only had it for a short period of time. If they accelerate at 100%, they get $84,000, 50%. $42,000, and they still have some death benefit left over on that 50% acceleration. And here's a story. It always sits with me. We had a couple. They ended up buying about $250,000. It was mortgage protection. And one of the individuals came down with cancer, and they had to go to a different state for treatment. Well, when you go to a different state, remember, even if you have the best health insurance only covers your actual treatments. It doesn't cover travel. It doesn't cover experimental treatments. It doesn't cover food. And if you're married, guess what? Your spouse is probably going to take off, right? They're going to take off from work and they're going to go with you. Hopefully, if they don't, go see a divorce attorney. But the only reason they wouldn't is because you still have bills to pay. Mortgage doesn't care that you're undergoing chemo. Mortgage doesn't care that you had a heart attack. But you do. Your family does. You don't want to lose your house because you have to undergo radiation. You don't want to lose your house because now you have to go to dialysis. Listen, we are providing a solution. It is something that the client is able to actually take the acceleration and help pay those bills and pay those unexpected costs. And again, in this situation, the clients ended up taking the $173,000 tax-free. I really want to emphasize that tax-free, and they used it to make sure that they got to keep their house, that they didn't suffer that financial death, that spouse wasn't thinking, gosh, if I would have passed away, all of our problems would have been solved. Listen, I still want my husband, my spouse, my wife, or my husband with me. I don't want to think, well, we're now suffering and we had to lose everything so she could be with the family. We want both, right? So now you know they work, but how do they work? Okay. I always say there's two main parts, right? We have the claims process and we have the what's covered and how it's calculated process. Well, big question I get is when should I submit a claim? Always submit a claim. If your client has a covered condition, submit a claim, but when? Timing is crucial on this. First off, don't wait too long. Don't wait 2 years down the road, okay? Submit the claim within a certain amount of time, but also don't submit it too early. If I go to the doctor and he says, Justin, you have cancer, I'm not going to immediately run to one of my policies and say, hey, I really need to put in for this living benefits claim. I'm going to give it some time. I want as much information as possible. I want them to understand the staging, maybe what operations, what the treatment plan is, all of that other stuff. Right? So maybe I'm going to wait 3 or 4 months from that time of diagnosis, just so all of the records are there and the underwriting and actuarial team can make a good and decent decision. So I can make sure that I'm going to get the best claim as possible. So if you have a client and they said, I was just diagnosed last week, 2 weeks ago, I remember you were talking about the living benefits, have that discussion with them. Make sure they have all of the records because that is the number one step in the process. The underwriter, the company, is going to request all of the medical records, and you want all of that to be as detailed as possible so we have the best chance of success for a higher claim. Now, what's covered? Well, each company is going to cover something different, okay? Emeritus. very, very rich when it comes to the living benefits and what I like to call triggers, right? What's going to trigger the acceleration for that benefit? What's going to trigger that rider? Well, we see, I think they have like 18 different ways a client can actually access their death benefit. And that's cancer, stroke, heart attack, end-stage renal failure, major organ transplant, ALS, blindness due to diabetes, paralysis of two or more limbs, major burns, coma, aplastic anemia, benign brain tumor, aortic aneurysm, heart valve replacement, coronary artery bypass, terminal illness of 12 months, can't perform 2 out of the 6 activities of daily living for chronic illness, or severe cognitive impairment like dementia or Alzheimer's. Ooh, that was a lot. We can accelerate up to 90% of the death benefit, up to 1.5 million. And the best part about emeritus is the living benefits cannot be removed from the policy if it's issued table 4 or better. So we had an issue. We had a client, she really wanted living benefits. We tried with one company. They said, hey, we'll go ahead and issue this, but we're going to remove the living benefits. We went to another company, exact same story. So we took it over to Emeritus. Now, with all of that being said, what do you think that the client's rating was? Preferred. It was preferred across the board, but each of the carriers wanted to remove the living benefits based off of back pain, a back surgery that they had. Where Emeritus came in and said, hey, preferred, we can't remove them. She gets to keep the living benefits. Wow. Can you imagine getting a preferred rating, but yet you still can't qualify for the living benefits? What if your client wants one? We have carriers, so really understand the underwriting for each of the carriers that you work with that has living benefits. National Life also has an amazing living benefit story, right? It has so many. There's all of the critical conditions. They also have critical injury. I think they have there's a chronic illness. They have terminal illness of 24 months, and again up to 1.5 million of acceleration. California. If you're in California, please make sure to check because the living benefits that we have in your state may not be the same as you're looking here. California agents always get a different brochure. Transamerica Trendsetter LB, here's theirs. Again, we don't have as many as National Life or Emeritus, but we still have a lot of great triggers, all of the major ones, the ones that are most likely to happen. Again, we have that chronic illness and again, the 90% death benefit up to the 1.5 million. I will tell you this, okay? If you're working with a client, unless you're spreading across these living benefits, I'm doing one with Trans, one with Emeritus, and one with National Life, and I'm looking for large coverage, well, we see that the max we're going to get is 1.5 million. Maybe we're going to only do, let's say, a $2 million term with Transamerica for the living benefits, but for the rest, if let's say I'm doing a $5 million policy, those other $3 million, I might just do on the regular Trendsetter product. Why am I going to have my client pay for these living benefits that he can't really accelerate, right? We're only going up to 1.5 million. So definitely take a look, make sure that you're working. Also, spread it across. If you're doing a permanent policy and an LB policy, you're going to have some wildly different options. And by the way, Transamerica, especially on their IUL and their permanent plans, do have those living benefits built in as well. And that can be very important because you're always going to see a higher payout on a permanent product than you will on a term product. So if you're working with a client, remember, we can always convert the term. It may be more wise to make that claim on the permanent product first. Now, I went through the main 3 that we usually work with and think of when it comes to living benefits. But remember, don't forget the other carriers that are in the market. Mutual of Omaha and their express products, their non-med express products have it. They also have a paid LTC benefit, which is again another living benefit type of plan on their IUL Advantage and IUL Protection product. Foresters has them built into their products as well, non-medical and medical. North American has them built into their term and permanent products. F&G has it built into their IUL products. Corebridge has it as a paid option for the chronic illness, one of the best chronic illness. In fact, something that we're going to talk about on using life insurance to kind of cover those long-term cares in the future. But again, if it's a paid for rider, you have a pretty much a guarantee on what you're going to receive. In that Corebridge, that guarantee is absolutely huge. Now, the next thing is, well, how much is the client going to get? Great, I have a covered condition. I'm going to go ahead and submit it. How much money am I going to receive as the client? Well, there's actually a little calculation. First off, they're going to again pull the medical records. They want to see what the severity of the health event is. Is it major heart attack? Is it very life-threatening cancer? What is the severity of the disease? Next, what impact does it have on the life expectancy? Now, you'll even see that, let's say I have a 20-year term and I'm in year 17 and I come down with cancer. I may get a lower offer than, let's say, if I had cancer 3 years into my policy. That's because the policy is about to end, right? And I'm going to show you a calculation that I pulled from an illustration. We're always going to see a higher amount come back from permanent because they're taking into consideration, well, the permanent's never going to lapse, so it's pretty much a guaranteed payout for the carrier at some point. We're going to have cash value that's built in, especially if we're working with IUL or whole life. There's going to be some cash value, and we're always going to see that living benefit, offer be higher than the cash value that's built into the policy itself. So again, permanent policy, if you're really planning for these living benefits and you want the highest possible offer, look to permanent before you go and make that claim on the term policy. Now you can make a claim on both and see what it comes back with, but remember, you can always convert your term policy into that permanent. You can do partial conversions as time moves on, and then, if anything happens, you can make those claim on the permanent plan itself. But some of those plans, especially that 250,000 where we were looking at, that was made on a term plan, right? The client got $173,000 and walked away completely. That was absolutely huge. That was on a term policy. But there's no guaranteed offers unless it's a paid for and it's an indemnity product like the chronic illness or an emeritus on the permanent plan, which we're going to talk about. The offers are not guaranteed. Just because I have a heart attack or I have cancer doesn't mean that I'm going to be guaranteed that full amount. Remember, it is an offer based on severity, life expectancy, and what that impact is. So I'm going to go ahead and submit it, and I'm going to see what that claim offer is. Now, the good thing is the company gives you or your client the option to be able to, either reject or accept the offer. If I don't like the offer, I'm not going to take it. I'm going to keep the life insurance coverage that I have. If I do like the offer, I can go ahead and take that option. So remember, really work through this with your client and make sure that they're aware of all of the options that they do have. Now, there's a couple of different ways, right? We have a discounted acceleration, or they call the discount method. We also have the dollar for dollar, which is our indemnity, or in some instances, we might have like a reimbursement model built into an LTC. Understand what benefit that you have. And then we also have another one, which is called a lean option, which we'll talk about briefly on this next slide. But understand what option that your living benefit has, read up about it, and make sure that you can explain it, again, on a one pager. If you can't explain it in a couple of sentences or on a single sheet of paper, give us a phone call. We'll help you break that down for your presentation and your client. So here's kind of a quick, fast comparison, right? We have Emeritus, Corebridge, Moo, their Moo LTC rider, and then the Emeritus Permanent. On the Clear Edge, again, we have a discount, indemnity, accelerated death benefit, LTC rider, a lean option. I'm going to really point out this Emeritus option, right? This lean option here. Take a look at it. These are actual guarantees. Now it's a loan on the policy, so there's literally going to be a loan on the permanent policy. But if I have a qualifying condition, I can expect guaranteed 25% of the death benefit or 250,000, whichever is less. If I have a chronic illness, I can expect 50% of the death benefit or $1 million, whatever is less. If I have a terminal illness, 75% of the death benefit or up to $1 million, again, whatever's less. These are going to be more of the guarantees. And so if I'm speaking with a client and we're actually planning, and this is a crucial part, I may decide to go with Emeritus because I understand exactly how much money I'll have in the event I have a covered condition. We have the National Life, the North American, there's the F&G Pass Setter, the FFIUL, and then the Foresters, right? The Transamerica probably going to be very similar across their term as well. But if you want a copy of this, just go again, leave a comment, put it into the chat bubble. We'll go ahead and send you out a copy so you have this at the ready. Now, I pulled a couple of, scenarios and from the illustrations. So LSW, I ran a $500,000 policy. Again, if you notice, the payout rises with severity, right? Left to right. Category 1 is more of a minor. Category 4 is more life-threatening. Now, if you're talking with me, and you come and say, Justin, you have cancer. To me, that's the worst possible thing, right? That is life threatening. That's a category 4 to me. Medically, it's different. Can we treat it? Can you overcome it quickly? Now, I'm going to show you, look, at 55, if I come in and I have a minor event, look, I get more money. If I have a severe event, I get more money. If it's life-threatening, again, even more. They're giving you examples on how, the policy could pay out. Now, again, these are not guarantees. If I have a minor and I'm 55, it is not guaranteed I'm going to receive 50,680. Maybe they're going to come back at 60,000. Maybe it's going to come back at 40 or even heck 25. But this is giving you kind of a good guide of what could you expect. With a term policy, you're also going to notice, look, as I get older, what happens to the benefit as I'm getting closer to the end of the term? I'm getting lower offers. Okay, because the term policy is about to expire, right? Now, carriers will tell you that's not how we do it, but clearly we can see the older I get, the closer I get to the end of the policy. Obviously, it's also calculating in the life expectancy, right? And that impact, the less I'm going to see. Where if we take a look at their IUL product, look, I see a complete flip. Now, I will give you the caveat that an IUL is accelerating in cash value, right? I'm gaining cash value. It's accumulating cash value. So I am going to see higher payouts because it is taking that cash value into effect. Or into account, just like what we were talking about earlier. But we see as I get older, look, 178,000, same 500,000. Let's go back one, 50,000 here, over here, 178,000, 345, 691. Do you see where a permanent policy, especially cash accumulation policy, can give the client a higher amount just because we have those other factors that are built in? So again, if you're planning, if the client is afraid of that chronic illness, if they're afraid of that cancer, of that heart attack, planning using a permanent product, especially a cash accumulation permanent product, is going to give them a higher anticipated amount than if they were just to go completely with a term. Now, oftentimes I get people asking, well, I'll just get the term converted and then we'll go ahead and make the claim. You may not see a very big claim if we just did a conversion and making that claim right off the bat. So just be aware, just because we're converting it over to a permanent plan, we may not see that benefit immediately. Now, if it's 2, 3, 4 years down the road, we could possibly see a higher figure coming back for our client. Here's emeritus. Again, it's showing, again, minor to higher, so more severe. So we have anywhere from 100,000 to 346. Again, we have our terminal illness is going to be in this last column. And then finally, we have the emeritus IUL. This is going to be their guarantees. Again, we can have 25%, 50%, or 75%. This is, again, the $500,000 amount. So it's showing us what our guaranteed lump sum is. Absolutely amazing. Now, a client may come back, and we've had this before, and they said, hey, well, that's a lot less than what I was expecting. And this was a real client. So we had a 50-year-old client. She had the policy for about 4 years, had stage 2 breast cancer. And the company came back and said, well, accelerate your entire $250,000, and we'll give you $45,000 offer, right? Again, tax-free. She was really upset. She said, well, this isn't what I was expecting. I thought they were going to give me 250. Again, she didn't understand the process. Even if we explain it completely at the time of sale, oftentimes they may forget. But she was expecting 250,000. She was upset. I don't think I should take it. This isn't a good deal. And we had to break it down. In fact, the line was, when you were told you had cancer, did you pray for a miracle? And she said, yeah, I did. Your miracle was answered, right? If they came back and said, we're going to give you $200,000, she may be thinking great, but internally we know that's not a great prognosis, right? Great outlook for that cancer. So coming in at 45,000 means, it was stage 2. It did have some impact, but let's take a look at it as a business decision. So total premiums paid in was 3,120. They're going to give her a tax-free offer of 45,000 in this situation. She still has a good survival rate and would be insurable again in roughly about 5 to 10 years after remission. This money can be used today to pay for deductible and medical bills, mortgage and rent, food, other costs that come up, making up that spouse's rider. It is giving your client a lifeline where they may not have had one before. And it's all built into the one price that we were talking about. What we're doing with living benefits is we're giving clients more than just a death benefit. We're giving them a pool of money that they can access in the event they have a covered health event and a financial lifeline. We want to make sure that the client doesn't suffer that financial death because they're living. Now, thank you very much. I've gone slightly over on this by about 5 minutes. If you have any questions, comments, if you would like a copy of this presentation, again, go up to the top left, use that chat button, go ahead and send over the request and we'll get it out to you. If you have any questions about these, please let us know. I know this was a lot of information for just 20 minutes. Thank you very much. Have a wonderful day. Bye-bye.